let's not waste any time and let's go ahead and dive into it. So, options, part 2. Going to be talking about calculating risk reward with options. I know that's very important for a lot of you. Last week, we talked about the basics of options. Okay, and we're actually going to go ahead and recap a little bit of what we talked about last week. But now, I'm sure the biggest hurdle and maybe one of the bigger challenges is, Josh, I know calls and puts. I know how to buy them, right? I know how to sell them. I know it's important to look at the spread and the implied volatility. Like, I get this. But how in the world do I know what my risk is going to be? How do I know what my reward's going to be? Because it's not the share. It's not the stock. It's an option. It's a derivative. It moves with the price, but always never 100%. So how do I calculate my risk reward with options? That's going to be the main topic of today's lesson. But first and foremost, let's go ahead and recap last week's option part 1 lesson. So options are derivatives, all right? The value is derived from the performance of the underlying asset. It's not like buying a share. You buy one share, the stock goes up $1, you make $1. If you buy one options contract and the stock's price goes up $1, what's your P&L? What's your profit? Well, you'll never know. No, you will. We're going to talk to you guys about that today. So again, the option is going to increase or decrease in value based on what the underlying asset, the stock, right, is doing. Right? A stock option represents 100 shares of the underlying stock. If you think the stock is going to go up, you buy a call option. If you think the stock is going to go down, you would buy a put option. You wouldn't sell the put. You wouldn't short the put. No. Right? You think the stock's going to go down, you're going to go buy a put option because a put option will increase in value as the stock's price is dropping. Delta is one of the Greeks, very important Greek to know, to understand, especially when trading options. The delta is the amount the option contract will go up or down for every dollar the stock moves. The theta, very, very important as well. The theta is time decay. Remember, options don't work with you when it comes to time. Time actually works against you. Options have expiration dates like a gallon of milk. Eventually, it's going to be spoiled and you're going to throw it away in the trash, and that's it. You're no longer drinking that expired milk. Well, with options, you have what's called theta, the time decay. Again, time works against you. Eventually, those options will expire, and they will expire for $0. They will expire worthless. The theta is the amount of money you will lose for every day you hold the options contract. The closer to expiration, the higher the theta is. Some key takeaways, some tips, guys, from our checklist. Remember, when trading options, we want to be mindful of the spread, right? We want low spreads, tight spreads. Now, the spread is the difference between the bid and the ask. So, if the bid is $1 and the ask is $1.10, that is a 10% spread. We want to only ideally trade options that have under 5% spread. So that would mean the bid would be $1 and the ask would be $1.05. That would be a 5% spread because that is the difference between the bid and the ask. Under 5% is highly, highly recommended, most definitely for brand new traders in the stock market. Okay? Low IV. The IV stands for implied volatility. Okay? You want to know exactly what these are to a T, the definitions. Go back and watch part 1 in the video lessons library from last week. This is our checklist. Low spread, under 5%. low IV. My preference is under 70%. Some traders have a preference under 50%. Some traders will not touch an options contract if the IV is over 100%. So my checklist is a low IV as well. Ideally, under 70%. High open interest. The higher the open interest, the better. High volume, right? The higher the volume, the better. So when choosing an option contract in a strike, under 5% spread, ideally under 70% implied volatility. Find one that has the highest open interest and the highest amount of volume traded. Okay? When day trading, we typically take weekly expiration options. So that means options that expire this week. So that would be, say, Friday's expiration. Okay? Or, for instance, the SPY or the Qs, where there's 3 expiration days per week. Okay? They could be a Monday expiration if you're at Monday. Or like today, you would want to trade, ideally, my preference is today's expiration. The closest to expiration possible is ideally the ones we will be day trading. For swing trading, we want to go at least 30 to 45 days out on expiration. Again, this is a checklist for brand new traders, the ones that are just getting involved in options. Now, as you grow, as you learn more about options, okay, you can start making your own checklist. Maybe it's 10%, right? Maybe it's 50% implied volatility. Maybe you don't care about these two things. Maybe you go 15 days on your swing trades. But in the beginning, this is the safest approach. Under 5% spreads, under 70% implied volatility. The highest the open interest, the better. The higher the volume, the better. Day trading, we're taking these weekly expirations, the closest to expiration because they're cheap, they're more affordable, and they move quicker and faster. Swing trading, a minimum of 30 to 45 days out on expiration because remember, you have what we call the theta. And this is the amount of money you will lose for every dollar or for every day you hold the option contract. So if we know that the closer to expiration, the higher the theta is, that means the further from expiration, the lower the theta is. If we're holding these contracts from one day into the next, we want to lose the least amount of money for every day we hold it. So go 30 to 45 days out on your expiration, right? So this was a week one, last week's part one recap, what we talked about in regards to options. Now, again, this was not everything. That lesson was 45 minutes long. So dive into the video lessons library over lunch. Rewatch that lesson if you guys have any questions about that lesson. But this is a options part one recap. So moving on into what we're talking about today. How do we calculate risk reward? Sorry for the pause. I don't know why I paused. So let's start over. How do we calculate risk reward with options? There you go, buddy. There you go. So there are 3 easy steps to calculating risk reward with option. Step number 1, analyze the chart. That doesn't change. We're traders. We're technical analysts. We trade based on what we see on the chart, right? So analyze that chart. What is the setup? What's the pattern? Is it a head and shoulders? Is it a cup and handle? Is it a 2-legged pullback setup, right? What's the setup? Analyze that chart. Where's your stop loss? Where's your price target? Number 1 does not change. Any market you're trading, if you're trading futures contracts, you're trading equities, you're trading options, you're trading crypto, and you're a technical analyst, you trade based on the chart. What's your first step to calculate your risk and your reward? You look at the chart, you analyze the chart, you identify the pattern, the formation, the setup. You say, okay, here's my entry. Where's my stop loss? Where am I going to walk away from this trade? At what price am I going to lock in profits? That never changes. Now, if you guys want to get better at analyzing charts, figuring out where your stop losses go, your price targets. Go watch how to build a trade plan lesson as well in the video lessons library, right? Go look at the most popular patterns and their stop losses lesson in the video lessons library. How to take profits, how to identify profit targets. There's a lesson in the video lessons library. So make sure you dive into that video lessons library, especially today, if you want to get more information about where do I place my stops anyway? How do I identify price targets, right? What are the most popular setups and patterns, and where do my stop losses go on those setups and patterns, right? But number one, how do we calculate that risk reward? Step one, analyze that chart. Step number two, pick your option. Again, for day trading, we typically choose the options contract closest to expiration, as they are cheaper and they move much faster. For swing trading, we want to go out as far as possible, 30 to 45 days until expiration minimum. And again, why is that? The theta, the further away from expiration you are, the theta is lower. You're not going to lose as much money for every day you hold the contract. Yes, they're more expensive. The further out you go, they're more expensive, but the theta is much lower. You're not going to lose as much money in time decay right off the bat. So I would say, as a brand new trader, 30 to 45 days until expiration minimum for swing trading. Step number three, do some math, right? Hey, we got to do some math, guys. I don't like math. I was never good at math, right? But if you have to, grab that calculator, right? Pull out your calculator, guys. Grab it. Use it, okay? You have to just pull up your calculator right here on your computer, right? We're going to do some math. Grab that calculator if you need to, okay? And we're going to assess what your risk reward is. Right, moving on. Here's an example of how we analyze the chart, the setup, the pattern, the entry, the stop loss, the price target. Okay? Step number one, look at the chart. Look at it. What's the pattern? Well, it looks like we have a little bit of a wedge, right? We have a nice wedge formation, a nice symmetrical triangle formation. We have a squeeze formation, okay? So we're analyzing this chart. What's the setup? What's the pattern? Do your technical analysis. Where would I like to get involved? Where am I going to place my stop loss? Where am I going to take profit? Okay, step one, setup, pattern. We've identified the setup and the pattern. Second part, stop loss. Where's my stop loss? Down here underneath these prior lows, this red line, stop loss. Okay. Price target. Where's my price target? Well, I'm going to say up here off pre-market highs, this blue line, price target. All right. And now what's my entry? This green line. If we break out of this symmetrical triangle formation to the upside, that's where I would want to go long. Right there. So again, you have everything you need. You have your entry, 432. You have your target, 438. You have your stop loss, 430. That is $2 a share to the downside. That is $6 a share to the upside. You've analyzed that chart. You know the pattern. You know your entry. You know your stop loss. You know your target. You know it's a great risk to reward. You're going to risk $2 to make $6. That is a 3-to-1 risk reward ratio. Remember, minimum 2-to-1. So guess what? We're exceeding that. 3-to-1 risk reward. 3-to-1. Fantastic. We've analyzed that chart. We're prepared. We've built a plan. Now we can go to step number 2. Pick your option, right? So pick your option. First, we're going to talk about day trading. Okay, so here's an options chain. Like, which option do I buy, Josh? Do I buy, one of these ones here in the blue, right? These are what we call in the money, ITM, right? These ones that are in blue are what we call in the money. They are in the money. Right here, right below in the money is ATM. That stands for at the money. And then these ones down here, right? All of these down here, these are going to be OTM, out of the money. So should I buy in the money? Should I buy in at the money? Should I buy in out of the money? Which one should I buy? It doesn't matter about in the money, at the money, out of the money. That does not matter. What matters is the delta. The delta. Remember, guys, the delta is the amount the option contract will go up or down for every dollar the stock moves. So if the delta is going to determine what my risk is and what my reward is, maybe I should focus on the delta, right? So let's go focus on the delta. For this example, we're going to use a delta 0.28. 0.28, okay? First off, what's the spread? 64 cents, 66 cents. The spread is very nice. I'm going to spend 66 cents per contract, or $66. Now this has a 0.28 delta. That is $28. So what's this telling me? That I will make $28 if the stock goes up $1. I will lose $28 if the stock's price goes down $1. And remember, we've already built our plan. We analyzed that chart. Remember? We have an entry, we have a stop loss, and we have a target. What is that? That's a stop loss of $2 per share. So we know our stop loss is $2 per share, correct? Correct. We know what that stop loss is. $2 a share, right? We know our target is $6 per share, right? We've assessed that. Our target is $6 per share. That is a 3-to-1 risk reward setup. So what does that equate to? This is when we have to, team, grab that calculator if you need to and just do a little bit of math. So we have a $28 delta times the per share loss of $2. Okay, so $28 per dollar move, but our stop loss is $2. So it's going to be 28 times the per share loss. What's our per share loss? It is $2. So 28 times 2 is 56. So that means your stop loss is going to be $56 per contract. For every one contract, right? That's one contract, $56. Right? So we know our stop loss, okay? What is going to be our target? What's our profit? Again, 28 delta times the per share target. Well, the per share target is $6 per share. So 28 times 6 is $168. So that means when we sell this, we could look to make right around $168 for every one contract we hold. Okay? It's that easy, guys. Seriously, it's that easy. Options can be intimidating. Look at all of these numbers. Look at all of this stuff moving. It looks like a big old Christmas tree half the time, right? Do I go in the money? Do I go at the money? Do I go out of the money? Who cares? That does not matter. What matters? What matters is how much am I going to lose? How much am I going to make for every dollar the stock moves? How do I determine that dollar amount? I have to look at the delta. The delta is what's going to determine my profit loss. So again, we found one with a $28 delta. Okay, we look at what we're risking per share, what we're looking to make per share, and we do some simple math. 28 times $2 a share equals $56 loss. 28 times $6 a share is a $168 profit. I have just determined what I'm going to risk on the trade. So from green line to red line, I'm risking $56 a contract. From green line to blue line, I'm looking to make $168. So you see how we just took all of this options data, right? We looked at this options chain, very confusing at first glance. And we were able to take a couple pieces of information and go and overlay it on the chart, right? Everything you did on the chart's exactly the same. Your entry, stop loss, your target, the pattern, all of that's the same. The risk to reward, it's all the same. But now we can take all of this option data, everything we see here, and we can do what we call overlay it onto the chart. And we now know for every one contract I hold, if I hit this red line, my stop loss, I would lose roughly $56. If I hit this blue line, I would make approximately $168. That's how you calculate your risk to reward with options. All right, now let's talk about swing trading. Okay, swing trading, it's the same thing. Same thing we just talked about. In the money, at the money, out of the money. Honestly, does not matter right now at this point in time. Right? Focus on the basics. Simplify the process. What matters? Delta. Okay, but when we swing trade, we're holding the contract overnight for an extra day, 2 days, 3 days. Remember, the theta is time decay. This is the amount of money you will lose for every day you hold the options contract. So now the only variable that's changing on a swing trade, the only variable that's changing is the theta. So now we do the same thing, team, right? We do the same thing that we did with day trading, okay? 28 delta times $2 per share, $56 loss. 28 delta times $6 a share, $168 profit. That does not change. But now what do we have to do? We have to start subtracting the theta. So let me ask you guys a question. If you're going to make your loss is $56, right? If you get stopped out without looking at theta, without looking at the theta, just the plan we've built, if you get stopped out, you're losing $56, correct? We're all on the same page. If you hit target, you're making $168, correct? We're all on the same page. So if you hold this contract from today, Wednesday, into tomorrow, what is your new loss? What is your new reward? So the only thing you have to do is subtract the theta because you're holding it 1 day from today, Wednesday, to tomorrow, Thursday. Very easy. Well, I already know it's a $56 loss based on the chart. So all I do is I go 56 and I have to add another $65. Okay, so get out my calculator. Well, I'm losing $56 on the chart. But if I hold it tomorrow and sell it at a loss, I have to add the theta. So that's going to be another $65. So plus 65. That means my loss for holding this option overnight would not be 56. It would be 121 for holding this one extra day. I can do the same thing for profit. So if I hit my profit target tomorrow, okay, I hold that contract for a day. So I would make 168, but I held the theta. I held the theta. I held the option overnight. I'm going to lose the theta. So 168, right? Minus the theta, 65. So my new profit would be 103. Take a look at this now. From what was a great risk reward, 3 to 1 on a day trade is now less than, right? A 1 to 1. Your loss, 121, is more than your profit, 103, just because you're holding the contract overnight. This is why I always say Never turn a day trade into a swing trade. I'm going to put even more emphasis on that with options. Never, ever take a day trade into a swing trade. You go from a potential 3-to-1 risk reward, making 168 bucks, losing 56, to losing 121, but only making 103. Does that make sense? Absolutely not. This is why we do not swing trade close to expiration. Now, this is a Friday expiration here. So this what we're looking at here expires this Friday, right? The theta is bigger than the delta. You would have to get a $10 move, $12 move to the upside for this to make sense. So that's why we don't take close to expiration swing trade options. We go further out. If we go a month out, that's probably not going to be 65. It would probably be 15, right? It would most likely be 15 for this example. So what does that equate to, right? What does that equate to? You just redo the math. Instead of subtracting and adding 65, it's 15. It's not going to be bad anymore. It's going to be much better. You can swing trade that. So my rule is the delta needs to be 2 times greater than the theta. So the delta needs to be 2 times larger than the theta when you're looking to swing trade. Okay? That's my rule of thumb. If the delta is 28 and the theta is 28, I don't recommend doing that. And in this example here, the theta clearly outweighs the delta by a lot. This is a no-go. You will not swing trade these. And if you do, you are putting on too much risk. You are gambling. So the delta needs to be greater than the theta. That means this would have to be 0.14. That would make this an ideal option to swing trade overnight. Okay, we following along? Okay, we know how to analyze the chart. Setup, the pattern, the entry, the stop loss, the price target. We now know how to pick the option for day trading. We now know how to pick an option for swing trading. And we know we just have to do some basic math. The math is going to be different from day trading versus swing trading. The only thing that's different is we have to start adding in the theta for swing trades to get an idea of what the P&L is going to be for tomorrow, for day 2, day 3, day 4, day 5. How many days are we holding it? Do that math, okay? So as a new trader that has never traded options, I highly, highly, highly recommend you pick 3 to 5 stocks max. I think that's honestly too much, but I would say 3 to 5 stocks at the most to trade options with. For example, the SPY. Definitely recommend you start with the SPY. That's number 1. The Qs. Definitely recommend you start with the Qs. That's number 2. Apple. They're cheap. They move. They're a little bit safer. They're not as crazy, right? Apple's a great one. If you had to pick 3, I would pick those 3 right there. Now, I threw an extra couple in there. Maybe Disney, AMD, right? But those 3 right there. So scratch the 3 to 5. Focus on 3. SPY, the Qs, or Apple. Cheap option contracts, and they move very, very well. Get to know these stocks, team. How do they move? And how do the options react to the stock's price? Every option is going to react differently to each stock. So get to know the options you are trading. Another reason I recommend those 3 stocks is because newer traders tend to drift off and they start trading penny stock options. These options can be considered extremely risky. And the reason they're considered extremely risky is because the IV is usually really high. They have a low open interest, low volume. The spreads are massive. That's why they're considered to be high risk. So I recommend those 3 because it allows you to get to know that stock, know the option. How is it moving? And it's going to prevent you from drifting off to trading options on penny stocks. Now, I'm not saying you can't do that. I'm saying you need to be skilled. You need to master the art of options trading first on a safer stock. The SPY, the Q's Apple before AMC, GameStop, right? Netflix, Tesla. Master it first with one contract on one of these 3 stocks, then go into a riskier option, the Teslas, the Netflixes, then even riskier if you want, which could be a penny stock option. I literally, team, have a set list of 30 to 40 stocks. The list barely changes. Maybe a couple come off and a couple add on. Think of it like an ETF. This is my list. Think of this like an ETF, right? It doesn't change. This is my set list of stocks. Every now and then, I may take Boeing off and add in something else. I may take Playboy out and add something else. But this is my list of stocks that I will look at every single day. And I'll see if there's anything that stands out. If Microsoft looks appealing, I'll put it on my intraday options watch list, right? Does Netflix look appealing? I'm not going to add it here. Does Coin look appealing? I'm not going to add it here. I go through all of these stocks every single day. I know these stocks. I know how they move, right? I know how the options move. Again, we built this watch list when we were doing options. This list barely changes. There's been a few names put on and a few names taken off. But for the most part, this list is 90% consistent. And what I do is I look at each and every stock in pre-market, one by one by one by one. And if I see a few on this list that look really nice for a day trade, I will take them from this main list to my intraday list, intra options. That was Disney, Microsoft, Apple, Nvidia, Tesla. I'm always watching the VIX right now because the market's volatile. I was watching the TNX, 10-year treasury yield. And then I'm always looking at the Q and the SPYs. Always. These never come off. These top 2 never come off. But tomorrow, guess what's going to happen? Disney's off. Microsoft is off. Apple, Nvidia, Tesla. These are coming off. What am I doing? I'm going back through this big list. Maybe Home Depot's on here tomorrow. Maybe Roblox is on there. Maybe Spotify's on here. I don't know. But I know these stocks. I know how they move. And when we were trading options last year, right, I know how the options move with these stocks. So that's how I do it. And that's how a lot of professional traders do it as well. They don't come in and just trade SPCE because it's ripping today. They don't just come in and go trade BBIG options. No. Professional options traders have their set list. And 90% of the time, those are the only stocks they trade. Every now and then, maybe some GameStop, maybe some AMC, maybe SPCE, maybe some BBIG. Shoot, I took some BBIG and ATER with you last year, and it made like 500%. It's rare. For the most part, it's that list. But every now and then, when another opportunity presents itself, we will attack it. So get your set list, right? Eventually, you will set a list of 10, 20, 30 stocks. You will review those every single day. These are going to be the only stocks that you would normally trade 90% of the time. But to start, the only ones that you should be trading, the SPY, the Qs, and Apple. One contract, not 2, not 3, not 4. One contract. Minimum 30 days. The more the better. 30 days is not enough to understand how the option moves, how the stock correlates with the option. It's not enough time. 30 days minimum. I prefer 60 to 90. That's what I did. I'm sure that's maybe what Matt did. One contract. And then once you build confidence and you have data, right? You're reviewing your trades. You're logging your trades. Man, I'm not doing good here. I'm doing really good with this strategy. Doing really good with this strategy. And I'm doing good with this strategy. So these are like the 3 go-to strategies. All right. I'm confident. I'm seeing success, right? I'm going to scale up 2 contracts. 30 days. What are my results? Still good. Fantastic. I'm going to go 4 contracts for another month. How are my results? Really good. I'm making some serious cash now. Let's go 8 contracts. Whoa, okay, whoa. All right, it's a break-even month. I got a little too aggressive, so maybe 8's too much. Let's try 6. 6 contracts. All right, not bad. 6 contracts? Okay, not bad. Stick with it. That's your ceiling. That's your peak for that point in time. That's where you're consistent. Okay? And then maybe step back into 8. Like, okay, I'm doing good with 8 now. Cool. Now 10. And before you know it, it'll probably take you a year or 2 years. Probably take you a year or 2 years to get to what Matt does. How many contracts does Matt trade at a time? 30. 30. Whoa. Yeah, dude, 30. But did he start trading 30 contracts on day 1, month 1, within the first 6 months? I highly doubt it. I could be wrong, but I would say over a year before he even got close to 30 contracts. He was patient. He took his time. He was disciplined. He made sure he was reviewing and logging his trades, making sure he was ready to take the next step and scale into more size. So do that. Be like Matt. Matt's a great trader. Phenomenal options trader. Learn from Matt when he's in chat, now that his kids are back in school. All right? So again, team, recapping last week, some of the basics about options, and really today's point was how to calculate that risk reward with options. Again, analyze your chart, step 1. Pick the option, step 2. Do some math, step 3. Step 1, analyze the chart. Step 2, pick your option. Step 3, do math. 3 simple steps to calculate your risk reward with options team. And lastly, focus on these 3 stocks. SPY, Q, Apple. 1 contract at a time, minimum 30 to 60 days. Minimum. And then before you know it, you'll have 2 contracts, and then 3 and 4. Before you know it, you're building your own set list of stocks that you trade. Not what I trade, not what Matt trades, what you trade. And that's what's going to make you successful. So team, that was today's lesson, options lesson part 2. How to calculate your risk reward with options. Do we have